The stock market rally that was underway yesterday, Friday, February 7th, 2025, was abruptly ended after the University of Michigan published its preliminary consumer index for February. The estimate was 67.7 versus the consensus estimate at 74 and the January final number of 71. What spooked investors more was that the expectation for inflation over the next year jumped to 4.3% compared to 3.3% in the January final number. I view actual consumer spending numbers as being a more relevant indicator of consumer sentiment than a survey. However, many investors believe that a downtrend in the consumer index can be a leading indicator for consumer spending. Based on the last data that we have about consumer spending, it remains robust. The GDP estimate for the 2024 fourth quarter had real personal consumption expenditures up 4.2%. That is the first estimate for that quarter made by the government. There will be more to come. For 2024 compared to 2023, real personal consumption expenditures was up 2.8%. The 2024 first quarter lowered the annual rise some since it was below trend at 1.9%. The January jobs report also fed into inflation anxiety some in that the average hourly wages increased by 17 cents per hour, which hints at least the possibility that there may be more wage increase pressure building again. PCE prices increased 0.3% in December and were up 2.6% in 2024 compared to a 2.7% increase in 2023, or almost no progress on the inflation front over the past year. Inflation is proving to be sticky at close to current levels. And two other inflationary pressures may result in an uptrend in inflation off the current levels in 2025 and into 2026, and that may explain the increase in inflation expectations that showed up in the February advanced estimate of the University of Michigan's Consumer Index. Those potential two causes are easy to identify. One is the tariff threat, and the other is mass deportations of unlawful immigrants that will at some point create supply chain disruptions and higher prices, primarily in the agricultural and construction sectors. Going back to last Friday's stock market decline that accelerated into the close, while the University of Michigan Consumer Survey kicked off the decline, Trump's renewed threat of retaliatory tariffs just about doubled the point declines in the major index into the close. Trump was somewhat vague on what he intended to do, but simply stated that he was going to impose retaliatory tariffs next week on imports to meet whatever the tariff tax was on U.S. exports for the same product category. To the extent other nations have the same issue, where the tariff tax on U.S. exports is lower than the U.S. tariff on imports in the same product category, retaliation can be expected. But the retaliation would be in a different tariff category than the one that is subject to the U.S. retaliatory tariff increases. I suspect that more consumers, including many who voted for Trump, have started to realize that tariffs are not paid by foreign countries, they're paid by the U.S. importers of foreign products and will contribute to inflationary pressures in the United States. S&P Global recently estimated that the 25% tariffs on exports from Canada and Mexico, which Trump has suspended for a few weeks, would increase the cost of a $25,000 automobile purchased by a U.S. consumer by about $6,250. I will link the article discussing that estimate in the more section below. Trump's tariff taxes will be disproportionately paid by lower and middle income households. Balancing risk and rewards in a thoughtful and informed manner are not in Trump's toolbox. His brain is reptilian. They have always been trade-offs in a free trade regime. The primary benefit to the U.S. consumer is lower inflation, resulting in lower interest rates over a very long period of time as trade barriers were lowered. The negative impacts have been a hollowing out of the manufacturing jobs in the U.S., which has been a relatively small part of the U.S. labor force for several decades now compared to the service sector. And another negative impact is that the U.S. will run significant trade deficits with foreign countries as robust spending by U.S. consumers, in part based on spending ever-increasing amounts of borrowed money, outpace foreign country and their citizens' demand for U.S. exports. So turning America back to protectionism, which is what Trump intends to do, will lead to higher inflation and a gradual return of some manufacturing jobs, provided the high tariff regime stays in place long enough for it to make sense for companies to relocate production into the United States rather than keeping it in the foreign countries. I will be discussing in my next two posts the purchase of over $60,000 in principal amount of investment-grade corporate bonds. Those purchases have not yet been discussed and were made through last Friday. I'm going to suspend stock trade starting next Monday until further notice, most likely lasting for several months. The notice of a resumption will be made in a YouTube video and in the comment section to my last blog. I will simply be posting two more blogs. The primary reason for writing the blog post is to have a steady reference for prior, a ready reference for prior research that I've done. And that helps me make stock investment decisions as my memory becomes less agile and frequently suffers from a malfunctioning memory retrieval issues. Since I will not be trading stocks likely for months, there's no reason to spend a lot of time, and it takes a lot of time to write these blog posts. I need to have more economic data on whether it makes sense for me to be a net stock buyer. I'm already down to a bare minimum in my stock allocation, which is less than 10% of the total investable assets that I have. As I've discussed in my blog and in YouTube videos, I am not comfortable now with stocks for a number of reasons, including valuations and potential negative impacts flowing from changes in domestic policies, and may need a major downturn before I assume more stock risk. I do not need to assume any at all. I'm generating now more interest income than my expenses, and that is far in excess of my expenses, and I have no debt. So interest income is sufficient for me to meet all living expenses, including extraordinary expenses.